Hey, good morning, everybody. Welcome back to the Mic Drop Show. This is where we talk about real estate, real freedom, and real results. Sorry for the delay in getting started this morning. If you're a regular attendee, just had some technical issues here this morning. But hey, I'm your host, Mike Morawski, the multifamily bounce back coach, investor, educator, and your favorite partner in cash flow when it comes to scaling your wealth through real estate. Hey, today's guest, super excited, good long time, good friend, who's dominating it in the markets. Hey, I'm sitting with Bronson Hill this morning, founder of Bronson Equity, former medical consultant turned capital raising powerhouse, and one of the featured speakers coming up this year on the multifamily summit in October. He's built different insights, and his mindset is that of the top 1%. Hey, Bronson went from grinding it out in the corporate world to generating passive income, building syndications, helping high income earners escape the 9 to 5 hamster wheel. So if you're somebody who wants to get that knowledge, that information, you're in the right place this morning. So if you're new to the show, please follow us, like us, love us, subscribe. We're always bringing you great content and information. Let me bring Bronson in here this morning and get that rolling. Hey, good morning, bud.
Hey, how's it going, Mike? I love how you're a morning guy. So let's go.
Yeah, I am a morning guy. That's what I said, man. I've been to the gym already and working that miracle morning for sure.
I love it, man. Well, I'm excited to be here, man. Let's drop the mic, man. This is awesome.
For sure. Hey, listen, I just want to acknowledge you this morning for the Wealth Forum and that group. Over the weekend, and I think I may have mentioned this to you, but over the weekend we got to spend a day and a half with a bunch of big thinkers, high income earners, and put in a room that just brought some real value. And the thing I said to you is, you don't know who shows up in your life or what shows up in your life that you might not even know you need until it shows up. It's almost like that old cliche that when the student's ready, the teacher appears. And I was just feeling some sort of way, prior to the weekend, and boy, that event just really fired me up. And I needed it, right? So again, I just want to publicly thank you for that and what you brought to the table. And if anybody's looking for, a good shot in the arm or help in building their future and where they're trying to go, Wealth Forum is definitely a great place to be.
Thanks, brother. Yeah, it was a lot of fun. It's great being in a great room and a lot of other great investors. And it's just, I think there's a saying, you're the average of the 5 people you spend the most time with. We hear this quote and everything, but it's like, I'll pay to be in the right room. I'll do what I can to move heaven and earth to get in rooms with people that are amazing. And so that's why we created the Wealth Forum with, other high net worth passive investors.
Yeah. So listen, fill in any blanks that I may have missed on the intro for you. If you would take a couple minutes.
Yeah, well, that was a pretty good intro. I mean, I think I should make you be my full-time hype man. I'm with, Mike skills like that. So, but no, I just really have a passion to help people develop cash flow, develop, things in life, really experience financial freedom. A lot of people talk about financial freedom. I think time freedom really is what's most powerful. My book Behind Me or Fire Yourself became an Amazon bestseller, and it's, we've sold thousands of copies, and it's just basically gets into how do I start doing this alternative asset investing thing, right? And a lot of times that's why, again, the reason the Wealth Forum is there and groups like yours and we set these conferences up is because we're kind of crazy, right? We think very differently than the average people, and we want different results. And I think that for a lot of people, they're taught to do stocks, bonds, other things, and they start talking to friends and family like, yeah, you're a little bit crazy. Why are you talking about this real estate all the time? But right. This is how people get ahead. I was an investment advisor for a few years in a former life, and no one creates wealth through just these traditional, highly diversified stock and bond strategies. It just doesn't work. And, what really you do is you buy private equity assets such as real estate, buying businesses, oil and gas, other investments that provide cash flow application or tax benefits.
Yeah. Yeah. What's interesting is, I think that you don't create wealth today in one place, but you have to have multiple places, streams of income, right? Maybe, real estate, maybe you're in your W-2, maybe some stocks and bonds, but I think a well-balanced portfolio, don't you?
Yeah, I mean, I think having different things is good. It's good to know what you want and where you're at. I think if somebody has a net worth of $5 million and they're a physician and they're making really good income, well, maybe it's about preservation. It's a little more of a defensive strategy, depending what your age is, and reducing taxes. There's a lot of people that are paying a lot in taxes, and we think actually for real estate, some of those tax breaks are going to come back with this new bill and some of the depreciation and things we were getting, where it was 100% bonus and accelerated depreciation. So I think you got to have a plan. Whatever you invest in, we do all different types of assets, but I think whatever your plan is, if you can figure out how to do it and do it in a way that's safe for you, that works for you, having some diversity of different things can be good. And just continue to keep learning. I know we're both in education, and it's just like some people think, hey, I've got to get to a place where I arrive or never make any mistakes. And it's like, hey, you're going to make mistakes, right? If you don't want to make any mistakes, you're in the wrong you're in the wrong area. You're gonna do things wrong. You're gonna learn. You get your butt kicked on certain things, and then you'll figure it out. And that's how we grow.
Yeah, absolutely. Absolutely. Hey, listen, let me ask you, I want to get into a couple questions. So what I traditionally do on the Mic Drop show is through the week, people send us questions to ask. We've been doing this now for a few months, and, it's kind of interesting. We get these questions. So I just want anybody to know, hey, if you have a question, this morning, drop it in the comments or DM me. Your question might get asked next week, right? Of our guest next week. But one of the questions that came in this week, it came in from actually an LP, a limited partner in a multifamily deal. And he's saying that when he reads a pitch deck on a property, what should he be looking for? How should he be examining that deal by just reading a pitch deck?
Well, I think pitch decks can be a bit overwhelming sometimes. Some of these are, especially even the PPMs or the paperwork with it. But how do you evaluate a deal just from the marketing? And sometimes there's a saying that the better the marketing or the better the pitch deck, the worse the deal. Or sometimes when a deal is really simple, because sometimes some of these are really polished. You look at them like, oh wow, this looks amazing. And so I think now I think with AI, everybody's talking about how AI can just dramatically impact your business. I upload everything in AI in ChatGPT or different things. I'll
Mhm.
upload, presentations or PPMs and start asking questions. Hey, what's the biggest risk here? What's missing here? What are the things what are the pros and cons here? What's something that I don't see? And I'll kind of sometimes even start with, I'll read through the presentation, I'll watch a presentation, and then I'll just kind of, put it in and say, well, what should I ask? What are some things that, really try to get a better understanding of the deal? And I think there's really two things in any deal you want to make sure you understand before you invest. And I talk about this in my book. The first one is, how am I going to make money? How's this deal going to make me money? Or how's this deal going to go well? Like, what's the case for this deal? And then secondly, what's the biggest risk of this deal? And if you don't, if you read it through and you don't see a risk there, then you probably don't understand it well enough, right? So it's really important that you understand what are some potential risks. Every investment, if anybody says there's no risk in investment, run. I mean, there's
Yeah.
always risk in every investment. So try to understand what you think the biggest risk is. Then ask ChatGPT, and then also ask the sponsor without telling them what you think. Hey, what do you think the biggest risk of this deal is? And again, if they say, oh, there's no risk, or we've de-risked it, where it's like, well, that's not a good answer. Right? You want to say, hey, here's the biggest risk. Here's how we're mitigating. Or here's 3 risks. Here's how we're mitigating these. And so I think that you have to understand the upside, the downside, and then I just try to really make sure I understand that my values align with the sponsor. A lot of sponsors, I used to think we all wanted the same thing. And what I've realized is some people want to raise money from investors and they never want to hear from again. And it's really frustrating if you're an investor, right? So there's little clues. If you have a call, you look on their website, you kind of see what's important to them, look for any reviews or anybody that's worked with them, and you learn about them. You learn about who this group is, and are they really looking for partnership? When we work with, I know you as well, Mike, when you work with investors, you want to communicate, you want to reach out, you want people to get back. From your team, you'll get back within, usually we try to get back within 1 business day if we can, if at all we can. And so it's just like, those things are really important, and they're things that really create a partnership. And so I think those are, what are the risks, and what would partnership look like on this deal?
Yeah, that was an awesome explanation. But I want to go back to one thing you said. What's the risk, right? Do you think that risk is different in every deal? And let's just talk about multifamily, because I know you do some other things, other than just multifamily, and you do some gas and oil, and you've done some other deals, and we can talk about that a little bit. But if we look at multifamily, do you think every multifamily deal has different risk than, or if the occupancy drops, we're at risk, right?
Yeah, yeah, no, that's a good question. I would say the idea of risk, I wish it was super cut and dry where it's like, oh, this is a multifamily deal. Well, here's the risk, or this is a oil and gas deal. Here's the risk. And there are some common risks among different deals, but I think every deal is so different. And I think when it comes to analyzing risk, I'll just kind of share this. We had some deals a few years ago that we thought were very kind of low, moderate, very mild risk, and then very quickly, when rates rose, those deals ended up becoming pretty high risk. And it wasn't like, I guess the miscalculation that I made is that, there are black swan events that come up. And when there's a problem, a lot of times with a multifamily or real estate deal, a lot of times, not every time, but a lot of times it's around the debt. A lot of times, like if you have a short window, you've got a 2 year, or you've got some sort of shorter debt. And then what happened, we saw from 2021 to 2023, is there was over 24 months, the same property in Atlanta that we own had a 40% decrease in the value, just in the same condition, right? So, there's a couple things there. One is that we didn't see that coming, right? So sometimes the biggest risk is the one you don't see coming. And
Right.
so I think, different markets are affected differently. There's also an operator risk, like who's the operator? How are they operating? Are they, are they going to try to renovate the whole thing right now? Or are they going to do it kind of periodically over time? And everything looks great on paper, but things never go the way you plan. They go better in certain areas, they go worse in other areas. And you hope that as you do a deal, you just have fewer things that go wrong. And this is where sometimes, especially now, I've gone a little more where it's like, well, I like deals that sometimes are even more conservative. That might be said, I'm looking for an 18% return per year, maybe I'm looking for a 12%, right? And hopefully we can outperform that, right? So I think that sometimes higher numbers don't always mean better returns, and often they can mean higher risk.
Yeah. Yeah. So you had mentioned you didn't see something coming. What caused that deal to change that you didn't see that risk, ahead of time?
Yeah, so the black swan event that, black swans are basically things like such as COVID. Nobody really could have predicted COVID or something. If they're
Right.
really in the conspiracy theory, maybe they could say predicted COVID, but to have the implications that have the lockdowns, that's just totally unprecedented. So that these black swan events. So for really in this specific deal, what happened was interest rates rose faster than they had in over 40 years. Right. So when that happens, all of a sudden, and my assumption was, hey, yeah, interest rates may rise a bit, but we've got, a couple of years to really go in and renovate these units. There is a margin of safety because we're renovating. But the problem is if you're 20, 25% down on a deal, you've only put 20, 25% down, and you've got a 40% decrease in the value of a certain, or maybe 30, 40%, you have no margin. You have even negative margin to try to get that deal to work, right? There's some real challenges. There was also some issues in this specific deal where COVID, because of COVID, they extended the eviction moratorium like an additional, it was a couple of years after COVID or something. So it was just, you couldn't get people out that weren't paying. There were some other issues that we just didn't see, right? So I think that, again, the more margin of safety, that's a Warren Buffett phrase of just, if things don't go exactly how you want, do you have a margin built in? And how big is the margin? How big is the buffer? Obviously, fixed debt would have helped that a lot. More money down, putting sometimes 40, 50% down can be more conservative than doing 20% down. And so, for a while, some of these deals, there was a few years in there where they really didn't work using conventional debt. You had to take out a lot more leverage. And whenever you have higher leverage in a deal, you always, you're adding more risk. You can say, oh, I want to
Yeah.
value add, I want to do this, I want to do that. Well, if things don't go according to plan, how stable is that deal? So again, and some of it depends on the operators. There's a lot of different factors that are dependent, but I think that really, continuing to explore that downside, because as Warren Buffett says, rule number one of investing is don't lose money, right? And
Right.
if you do this for a while, eventually you'll probably lose some money. Hate to break it to the listeners, but you're going to have things that don't go as well. And so it's not just what happened; it's what did you learn from that, right? What did you learn? Well, for me, I learned, okay, more money down it makes it safer, and then longer term fixed debt is much more attractive, right? So those are things that we try to look for.
Yeah, awesome. Hey, listen, you mentioned your book. Why don't you talk about your book a little bit, and help and tell people how they can get it?
Yeah, thanks. So, Fire Yourself, basically, it was, I've had over 2,500 calls now with high net worth investors. And it's just a guide of, hey, I know I should be doing real estate. I want to get into passive income. A lot of people think passive income is owning a rental house or online trading strategies or some sort of online business. And it's just not. Those things, it's really difficult because you can't scale. Even if you have a rental house or you've got three, I had four, and I thought, if you can't 10x what you're doing, you couldn't immediately go, for me, in my example, from 4 rental houses to 40 rental houses. Even though I was not the property manager, it was a lot of work. I was getting calls. It was they were out of area for me, but I was getting calls. Hey, what do we do here? The tenant's not paying. The city's upset about this. We need this repair. It didn't never worked out quite the way I wanted. And I just couldn't. It was hard to think about scaling up, and I wasn't cash flowing. And so that's where, what does it look like from all assets? Okay, what are my goals and how do I get there? It could be real estate, could be oil and gas, could be buying businesses, could be different things. And there's ways passively to do this. So that's why I created, Fire Yourself. And of course, we've got a whole community to really help kind of walk that out of how do we get to a place where I don't have, work is optional. I have enough money covering my living expenses, and I can go to work if I want to. But if God forbid something happened to me or a family member, I could take time off or travel the world or whatever, and I'd be okay.
Yeah, that's awesome. How do people get it?
It's available on Amazon. So you just go to Amazon, search Fire Yourself Bronson Hill, you'll find it.
Awesome. Great. Hey, so here's another question that came in this week. And this woman asked, she said, hey, I'm a high income earner. Should I focus on appreciation or cash flow?
Yeah, that's a good question. I would say for a high earner, and it depends. I mean, this is all like no specific advice, but a lot of high earners are professionals. So she could be a doctor, she could be a lawyer, she could have own a business, and I think for a lot of people, that those are appreciation or cash flow. And I ask this question a lot when I get on calls with people. And I personally think cash flow is more important because I think cash flow is what really allows you to leave a job. A lot of money someday, where it's good, but it doesn't actually give you the freedom that you want. A lot of times, I was making when I was in my high paying, I was making 200K per year. For some, that's a lot. Some people, it's not a lot. But
Right.
I was paying. I wasn't spending at all. I was investing. I was doing things with it. But I realized I only needed about 70,000 to live. Right, so that was only 5-6K a month I needed to live. So if I covered that number, which is really the rat race number of passive income, it would be enough for me. So I think for this person, you got to figure out what you actually need to live on. A lot of times we have living inflation, right? We just keep spending. We make more, we spend more. So that's an issue, right?
Right.
So I think having cash flow and starting to develop that passive income is huge. And then the third thing that is not mentioned a lot is the tax savings, right? So if people are somebody's making a lot of money, there are investments that allow people to reduce ordinary income, right? And again, no specific tax advice, but oil and gas has been proven to do this. Typically 80 to 85% of the amount invested can be year one depreciated for a non-real estate professional, it's kind of a silver bullet for a lot of people. Now there's a lot of caveats there. You got to find the right operator, the right deal, those kind of things. And so those are important. But I do think generally cash flow is most important because again, it's not that maybe she loves her job, maybe she loves what she does in her business, but what happens when she stops working or is not able to work anymore? What happens when, you get to a place that suddenly, all of a sudden, I want to be able to dial this down, and is she able to do it? And so I think those are things that are important for sure.
I agree with that a lot too. And you know what comes to mind for me is the typical residential real estate agent and even the commercial broker for that matter. You sell a house, you're out of business again, right? And you might be
Yeah,
a high income earner. I mean, I made a few $100,000 a year selling real estate.
right.
But you know what? I was always unemployed in between sales or in
Yeah.
between closings. And to have passive income in place, and this is the thing that doesn't equate for me is I have found that 95% of real estate agents do not invest in their own product, right?
Wow.
I don't
Yeah.
like to invest in real estate, right? And you and I are kind of real estate guys and business guys, and we like businesses and real estate, and I think there's that hamster wheel by being in a W-2 or being a 1099, and you're unemployed until you do the next flip or
Yeah.
you sell the next house or you get the next paycheck, right?
Yeah.
And the cash flow that you can create from being passively invested in multifamily, a gas and oil deal, a business, cash. You should build your passive cash flow to support your lifestyle.
Yeah, absolutely. And it's the part that I think people, I didn't realize this honestly, Mike, until I had a rental house. This was years ago. We're talking many years ago. That it was a house, first house I bought. I ended up moving to another state for a job, buying a house, and then keeping it when I left a couple years later, moving back to Southern California. And I watched, what started out as kind of a break even, $100 a month, to it became $200, $300, $400 a month. And I was like, oh, this is actually pretty nice to get this. I'm not managing this. It's kind of nice. And so for me, that was obviously, it became more, the higher maintenance over time, but just that idea of getting residual income was awesome. And I started to realize, if you could grow your passive wealth by, $10,000 a year, it was more powerful than like 50,000 active income, because you'd make that every single year. And that would typically grow over time. And so a lot of people we don't really think about that, right? Until you've experienced it. It's like a muscle when you work out and you're sore in an area you didn't know you had a muscle, right? It's like, oh
Right.
man, I'm sore, right? Well, how did I didn't even know that was there. But now, it's like, okay, I know I can get stronger there. So I think that for a lot of people, it's something, it's when you actually start experiencing it, it actually starts to really change the way you look at things, starts to change the way you make decisions. And if you can grow it over time, it's something that, again, 99% of people don't really ever get that. But I think that, that's what creates the opportunity, right? Is that a lot of people, you see opportunities in areas that people don't see.
Yeah, absolutely. So here, kind of last question. And I think this is kind of a broad question and could probably be answered from a couple of different places, right? And if we looked at it from, a new investor starting to invest, and this around multifamily. So a new investor starting to invest, or somebody who's been in the business for a while, has done a couple of deals. Should they focus solely on 10 to 20 unit deals, or should they skip and go right to a 100-unit syndication deal?
This is for passive investors
Yeah,
or
no,
for active?
for active investors. Thank you.
Um,
Great.
yeah, yeah, yeah. No, so I think it's a good question. I think it depends on your goals. For me, we did 4 single family houses, and the next deal was a 225 unit property. So, well, how would you make that jump, or why would you do that? And well, the biggest thing is there's team, right? I had a partner who'd done 15 years of different deals, had a great track record, had done very well. The project went very well. I raised some money for this deal, and so a lot of times we think in terms of, when we're scaling up, we think in terms of what we were doing before, right? We think of what we're doing with single family, right? So single family, you can do it with you and an agent and a property manager, right? And it can kind of just be you. When you have a larger multifamily, and this could be, 10, 20 years, you can maybe do by yourself. 100 units is hard to do by yourself, right? You may have somebody who's focused on the capital side. You may have somebody who's focused on, the operations, or somebody who found the deal. Or there's just different parts of the deal. And so it's very rare you see someone who does a whole deal pretty much themselves on a larger project with your own money and everything. So I would say go as big as you can, as quick as you can, just because it gets to be so much more efficient. You think of it just from a property management and a maintenance standpoint. If you have a 10 unit, you don't have an on-site property manager. They've got to lease it out. It's very inefficient. If this is a property management company, maybe they've got to have 10 different 10-unit properties that they have to manage for the equivalent of what it would be for one 100-unit property, right?
Yeah.
So it's very inefficient. So you don't get the same scale or the same efficiency. And then also, if you have a 10-unit, maybe somebody, you don't have a full-time maintenance person. The maintenance person's got to go to 10 of these 10 different units, probably with different owners, and they've got to go in and look at something and get a part and go to Home Depot and come back. It's the same kind of issue with single family, right? Is there's a lot less efficiency. 10 is more efficient, but it's still not as efficient because you don't have on-site people. Once you get to like, and I'd love to know your opinion on this, but it seems like about 60 units, 60, 70 units, 80 units, you start getting to be able to have on-site people that basically are there. They either live there, they're full-time there, or there's a maintenance person, there's a leasing or some sort of property manager. And it just gets to be run much more like an efficient financial asset. But how would you answer that one, Mike?
How would I answer it?
Yeah.
I think if you're a brand new investor coming into the market, and you've maybe only done a couple fix and flips or single family or not done anything, I think you should start with a little bit smaller one, get your feet wet, and then graduate up to the next one. Like my first multifamily, I had done a couple hundred single families, and my first multifamily was 11 units.
Yeah.
But then I went to 84, 187, 250,
Yeah.
so I scaled up, right? But I think you and I are a little bit different
Yeah,
than
you're more of an
most people.
operator.
Yeah,
You're
yeah,
more of, well, you're an operator too. I'm more of a capital partner, so I don't really do the day to day.
yeah.
So I think probably as an operator, I can definitely see that would make sense because you don't want to, you scale up to something that just feels overwhelming. It might be too much for you.
Right, right. Hey, listen, what are you working on these days?
Yeah, so we're working on quite a few things. I'm working on my second book called Rich Brain: How the Wealthy Change Their Brain to Change Their Bank Account. And so I'm really excited for that. I wrote the book. I've got to rewrite the book as I was doing. It's more of a series now, but that's just what are the mindsets around wealth that people can grow in and change and become wealthier? What are the things that are blocking that? A lot of people are curious. Why am I self-sabotaging? Why am I not getting what I want? So that's a big one. We're also doing more deals. We've got the three things I'm most excited about right now is buying private businesses. We're also doing oil and gas deals, a couple different types of oil and gas deals. And then we have a debt fund that focuses on real estate. So we're on the kind of being the bank and having some solid returns there. Those are the things that we're really focused on. And also it's, as we're recording this, it's summertime, getting ready to go to Alaska this week, going to Seattle next month, a couple trips with my daughter, looking forward to that. So just always planning my next trip.
Yeah, awesome. Hey, you're going to be a speaker, a return performer at the Multifamily Summit in October. That's coming up October 16th and 17th. Any insights that somebody listening in saying, oh, should I come to the summit or not come to the summit this year? It's a virtual event. It's 2 days, 20 speakers, some big names this year. What would you tell somebody who's on the fence or thinking about it?
Yeah, I mean, I think you invest. The first investment, the best investment you make is in your own education. And so some of the stuff can feel like, I'm busy, I don't have time, whatever. But like showing up to these events virtually now, there's really no excuse, right? It used to, cost thousands of dollars to go to these in-person events, and I still do in-person events too. But Mike puts together a great event, and I'm very excited to be a returning guest and excited to see some of the other speakers as well. So thanks for inviting me as a speaker. I'm excited to be able to add value and just share and something that can really help people get people to the next level.
Yeah, awesome. Thank you. Yeah, I'm super stoked about this year. This is a sixth year, and you're back again, I think the third time. So awesome. Hey, how do people reach out to you, get a hold of you if they want to talk to you directly?
Yeah, so you can reach out. We're on all social medias. The best way is I have a gift for your audience. I have a guide that I just wrote that talks about my 3 favorite cash flowing investments of 2025. So if somebody wants that, if you text the word cash flow, just all one word, cash flow, you text that to the number 33777. We'll send it to you, and you'll kind of hear about our future stuff we're doing, our newsletter, all that stuff, and you can reach out. But so if you text the word cash flow to 33777, would love to connect with anybody about anything you want to chat about.
Awesome. Great. I appreciate you being here this morning. I'm going to land this plane. If you want to hang around in the back room for a minute while I do that, we'll say goodbye.
Sounds great, man.
Thanks for being here, man. Appreciate you.
Thanks. Yeah, appreciate it. Thanks.
Hey, everybody. That's a wrap for this week's Mic Drop Show. Glad that you're here this morning. My guest, Bronson Hill, good friend and operator, educator, example of what happens in the world of passive income, in the world of creating cash flow for yourself. Hey, if you're still debating between local or out-of-state investing, small deals, big deals, cash flow or equity, let's give you some more insights. Give me a call. Let's jump on a call. Let's talk about your situation, kind of evaluate it. You can go take the investor risk tolerance test. Just type the word investor to 224-269-6700. Take that quiz and find out for yourself what where you should be investing, right? Or how you should be investing. But if you like today's episode, smash the subscribe button, would you? Let's help you continue to shift your thinking. Follow us so that you get updates and information. Remember, today's show was brought to you by our sponsor, Sync VA. If you are looking for an assistant, if you're looking for somebody who is going to help you either from a transaction coordination, from property management support, from an executive assistant, and you need help, hey, reach out to Sync VA. They will help solve that issue for you and put the right person in your business for you to help you grow. Hey, thanks for being here, everybody. We're here every week on Wednesday morning, and we'll look